Making equity great again, there is more liquidity than ever. Nobody knows what Trump 2 will be compared to Trump 1.
Welcome to The Big Question from Paris. I'm Angela Barnes and I'm joined by the CEO of Euronext, Stéphane Boujnah. Thank you very much for joining us. Now, Stéphane, it's been a very busy year for you at Euronext. In July, the outcome of the French elections resulted as we saw French stocks sliding as investors assessed risks from political gridlock. Do you think France's markets now are over the worst as a result of the political turmoil?
By all means, I do think so. The worst is over. There was a moment of uncertainty, which is understandable because snap elections are not very common in France. Having parliament is not very common in a French context. But the whole system is navigating through these new political realities, and the markets have understood that in reality there was no fundamental changes in the performance of companies in the overall environment.
In November, US elections, are you concerned about what a potential Donald Trump win could mean for the markets?
I don't know, because nobody knows what Trump 2 will be compared to Trump 1. And clearly the sort of momentum created by the Biden economics and the impressive stimulus program that has been deployed with the Inflation Reduction Act is probably going to continue to produce its effects, its positive effects. The direction of travel Powell gave at Jackson Hole was clear indication that we should expect a new stimulus environment with lower interest rates in the next few months, irrespective of the outcome of the election. So honestly, I'm not in a position to characterize what would be the Trump effect. What I'm more positive about is that for us as Europeans, that would mean a lot. There is a big difference between the sort of Mr. Trump agenda, at least as he has portrayed it, as described it, in terms of relationship with Europe, in terms of the burden for financing our own security, the future of NATO, the future of the support of Ukraine. I mean, all these things will be open for debate and will create more uncertainty. So for us as Europeans, uncertainty will be significantly stronger than what it is today.
And one of the challenges ahead for European markets, what we've had to deal with, we've seen in the last couple of years a lot of European companies opting for a US listing instead, for example, Birkenstock, and then recently we had Total Energies as well floating the idea of going over to the US instead. Are you concerned that we're going to see more companies, European talent, opting for US exchanges over European ones, and how can we make Europe more competitive to prevent them from doing that?
So I fully understand this attention focus on few companies deciding to move their listing venues to New York. But the situation has to be analyzed in a very granular way, because there is a UK situation which is specific, and there is a continental Europe situation which is totally different. So many companies in London are facing a situation where there is less liquidity in the London equity market than there used to be, and are considering moving to the US to address this liquidity problem. In addition to all sorts of other reasons, like more cozy CNP approach in the US, the fact that some companies have a very large business in the US, the fact that have an increasing part of US investors in their share capital table. All that are good reasons to consider moving to the US, but there is a UK situation which is specific. On the European continent, things are different. There is more liquidity than ever in the leading market for equity, which is Euronext. And then there's much more discrete and smaller number of companies that are considering that situation. When you refer to Total has a very specific company valuation problem, because their peers in the US continue to attract a lot of investors who are not very much oil and gas scared, because the carbon footprint issue is not dominating the collective preference of investors in the US as it does in Europe. And in Europe, there are more and more funds, banks that have decided to ban oil and gas from their portfolios. So there is an asymmetry between companies of the same size with the same level of profitability, attracting more investors in the US and fewer investors in Europe in that specific oil and gas sector.
The other thing, the task Europe has on its hands in the new Commission as well, with Ursula von der Leyen and co, they have once again put Capital Markets Union top of the agenda. We know how Capital Markets Union is appealing to businesses, but why is the CMU important to citizens across Europe too?
The fact that we don't have fully integrated capital markets is just an historical anomaly. And you have one huge difference between Europe and the US. By and large, if you put aside the UK, obviously in Europe, but let's say in the European Union, if you want to have some income when you are too old to work, too tired, you need to, in the rest of the world, you need to buy shares. This is long-term return. In Europe, if you want to have some income when you are too old, you need to hope and expect that young generations around you at that time will continue to pay taxes and to pay social contributions because the system is vastly financed through redistribution. Addressing the pension structure of Europe is going to be a fundamental driver to the re-equitization of Europe. The second thing is that we export a lot of savings to the US and we re-import equity investment from the US through private equity investment, large asset managers. And there is a strong incentive through all sorts of tax schemes all over Europe to invest in fixed income. So making equity great again, since you referred to Donald Trump in your previous questions, making European equity great again is probably to be one of the mottos, one of the priorities of the new Commission. So I'm super enthusiastic, positive, and confident that the new Commission, the new European Parliament, and the new Council of European Ministers of Finance will be very much focused on delivering the Capital Market Union.
Do you think it's incentives, and do you think there's also a lack of financial education among the younger generations about sort of not really knowing how to invest in equity markets, in capital markets, the fear of losing money?
I'm smiling because the question is about young generations' financial education resonates with a reality, statistical reality, which is the vast majority of the young generations invest massively in crypto assets.
In crypto?
In crypto. And investing in crypto requires an appetite for risk, which is significantly higher than buying a share in a blue chip company. We, in my view, the problem is different. Historically, before beverage in the UK, before the reconstruction years across Europe, before the welfare state, when people had to plan for rainy days, when they had a little bit of saving, they were going to the bank to buy a share in a railway company or to the post office to buy a government bond. And that's where they were building a sort of safety net for rainy days. Then the welfare state came and provided a sort of safety net for everybody, absorbed some of the resources that went to taxes to provide the safety net, absorbed through taxes the production of services that became public, like health and education to a large extent. And therefore, the approach of savings, the stock picking, which was a part of local branches of banks, disappeared. We are back, in my view, in a situation where people need to build their own safety net to equity investment. Actually, there is a slow progress. We have seen during the COVID year and the year after a progress where retail investments moved from 3% sometimes to 5% or 6% in some markets. It was a bit reduced. I would take the fact that the young generation is massively investing in crypto as a first step of them being ready for more equity investment. So what is really fascinating is that when you look at who are the new investors in shares, historically they used to be retired people who had time to do stock picking behind their screen. There is a significant trend of young generations taking over the old generations in shares investment.
Stéphane, do you think 2025 is going to be a good year for listings?
I think it's going to be a better year for a combination of reasons. The main one is the direction of travel on interest rates. Interest rates are going to stabilize and potentially decrease. So clearly, midterm return on equity will be stronger than on interest rates, and the appetite for the equity asset class will come back big time. One way of capturing equity risk is definitely to capture, to invest in IPOs. Also, the companies that have matured over the past 10 years in Europe in particular on the technology sector are now strong enough to consider an exit on markets. Also, the private equity world is facing more difficulties in raising new money than they were used to in the past few years. So exits to markets is becoming more relevant for private equity than it has been in the past few years, where secondary, third, fourth vintage or generation of private equity purchasing was the most obvious option. So the combination of private equity being less rich to buy assets from other private equity funds, combined with the fact that interest rates are decreasing, and therefore in relative terms investing in equity is going to become long-term more rewarding, combined with the fact that there is an offering of companies ready to go public, combined with the fact that there is a trend for carving out large groups. We have many large groups that have decided to simplify their organizations and to carve out some of their operations in public markets. All these elements make me very confident that 25 will be a good IPO year.
Okay, Stéphane, thank you very much indeed for joining us on The Big Question. Thank you very much for sharing all of your insights with us. It's been fascinating and a pleasure to have you on the show. Thank you.